Hello all. In this particular video, I just thought to quickly introduce you to one of the concept called a balance sheet driven agile transformation. Okay, so say for one of my client in the very recent past, I have done a particular initiative called a balance sheet driven agile transformation, wherein we actually take a balance sheet of a particular delivery unit or a particular business unit at a portfolio level, and then try to come up with some dynamic strategies on the go so as to have a positive impact on the balance sheet numbers. So before I actually get into the actual transformation thing, I just wanted to cover some of the basic elements of the balance sheet in this particular video. Probably in one of my LinkedIn post, or in probably in one of my Facebook post somewhere down the line, I will try to upload a balance sheet. For now, in this particular video, I just thought to share you the high level approach of a balance sheet driven agile transformation. Okay, so before we get into that particular crux, one need to understand what is this particular balance sheet all about, because balance sheet basics and the financial statement basics will be known to people who have a good amount of commerce and economics background, but then the people who actually typically come from the engineering background may not have the basic understanding of a balance sheet. So a balance sheet is one of the financial statement wherein we actually try to quantify the assets and the liabilities. Okay, as the name indicates, assets and the liabilities need to be balanced at the end of the balance sheet. That is why it is called as a balance sheet. Okay, so what we generally try to do is, I actually create some kind of a columns like a balance sheet on what particular date, what are all the variable names, and what is the followed by what is the amount in a dollar value, and then the fourth column could be the comments or a interpretation just for our own understanding. Okay, now when you are trying to assess the when you are trying to quantify the assets, we maybe need to look into multiple sections like current asset, followed by the inventory, and then followed by the property or the plant or the equipment. So if you are taking a manufacturing industry, right, definitely they will be having some kind of a immovable assets, like in terms of the property, the plant and the equipment. Whereas in an IT domain, we may need to contextualize it in a better manner. Okay, now let us go one by one. What do you mean by assets? Assets are those things which you actually own it, or which you actually possess it, right? So in that particular section, I do have something called a cash and a cash equivalent, followed by accounts receivable, followed by the inventory. Now this particular section together we will actually combine it, or rather club it under the category called assets. When I actually talk about the liabilities, it could be current liabilities, or it could be the non current liabilities, followed by the owner's equity. So I actually don't want to complicate things. Let us try to understand the basics of the building blocks of the balance sheet, and then we will see in one of our subsequent video how you can actually interpret these particular numbers on a real time basis, how you can come up with a strategy at a delivery unit level or at a business unit level, so as to do something called a balance sheet driven agile transformation. Okay, now if you are taking the meaning of assets, in that I have created a couple of sections called a current asset, followed by the inventory value, and then followed by the property, plant or equipment value. Now let us go one by one. What did I mean by current asset? Current assets are those assets which has the potential to be converted into a cash within a specified timeline. Let's say for example 12 months. Then does this particular asset has that capability or the potential so as to get converted into a cash within the next 12 months? So within that particular current asset, I may have some cash and cash equivalent followed by the accounts receivable. Let us go now one by one. What do you mean by cash and cash equivalent? It has something saying like cash and cash equivalent could be a combination of cash in hand wherein you are focusing on the obligations and the profitability, right? That particular section is going to come under cash and cash equivalents. Now if you are talking about accounts receivable, probably I can focus on what is the totality of the inflow cash which is being expected within the next 45 to 60 days, right? So only with your balance sheet you should not take a conclusive call. You may need to look into the other statements or other financial documents so as to have a clarity on the net income value from the income statement before you comment on the account receivable in the balance sheet. So if I want to put it in a simple English, in this particular account receivable, I will be looking into the opportunity to turn that particular aspect into cash within the next 12 months, or what is the inflow cash expected within the next 45 days to 60 days, and then try to pull out the inferences from net income value from the income statement before I comment on the totality of the account receivable. In this, what are we trying to do? We are trying to analyze the aging schedule aspect, right? Because how many days this particular sales outstanding is actually going to give you a pointer, then followed by the inventory. In the case of an inventory, we may also need to look into the expiry date. See, now the point is that typically in a software industry, you may have you may actually have your capital expenditure versus your operational expenditure, which we actually call it as a capex or a opex. But then if you are trying to understand balance sheet not only from an IT domain, across the domain, some of the industries do have a expiry date. Say for example pharma industry, or if you are taking food industry, those particular inventory do have an expiry date. So factoring those particular details also, inventory cost need to be considered. Okay, so we have actually touched upon the basics of current asset, the cash and cash equivalents, followed by the account receivable, and how are you going to factor your inventory. Now, if in case I am going to factor my property, plant and equipment, then by and large I also need to factor the depreciation. Why? Because these equipments may become obsolete. So it always has a depreciation aspect or a dimension tag to it. So when I am putting the property, plant and the equipment in my balance sheet dollar value, I will also put on the right side the comments pertaining to the obsolete aspect of it. That is why whenever you are reading a balance sheet, first look into the date. That balance sheet is the balance sheet as on 31st December 2021. It may not be the reality as on date. Okay, now we have little bit try to understand the building blocks of a balance sheet. Now let me little bit go into the liabilities. Liability means what you owe, means what you need to pay. Whereas if you are looking from an assets point of view, those things are what you own. So what you own becomes an asset, and whereas what you owe becomes a liability. Now if some people ask me, if you are having a own house, does a home become an asset or a liability? See, we need to understand one thing. Till the time we are paying the EMI dues for the home loan, we are not owning the house, right? The house is only owning us. So how it can be considered as an asset from a commonsensical approach? Forget about how does the balance sheet factor it. but certain aspects need to be kept in mind before I take a comprehensive call or a conclusive call whether this particular entity is actually a part of my asset or actually part of my liability. Now, in this particular section, if we are trying to look into the liabilities, what we owe, that particular thing can be considered here. Okay, now someone asked me, how do you factor your current liabilities? Current liabilities can be factored in terms of the obligations to fulfill within the next 12 months, right? What are all the obligations that me as a vendor or me as a company or me as a delivery business unit need to factor to my client or a customer within the next 12 months? So those things can be considered as an current liabilities. In the current liabilities, generally what we used to do is we used to have three main sections. One is called accounts payable, then accrued expenses, followed by the deferred revenue. See, now the point is, whenever you are trying to hear these words for the first time, it may sound Greek and Latin, which is perfectly fine, because every person, when you start to learn to drive a car, all are only elbowed license owners or learning license owners, learner license. So only thing is, first understand the English meaning of it, then try to understand the contextual meaning of it, and then go to the level of how you take these things and then try to come up with an ascending strategy, either as part of your agile transformation or as a part of a digital transformation or as a part of your business transformation. Even if you take me, I am from an engineering background. So for me, when I started hearing to these terms, cash equivalent, account receivable, inventory, accounts payable, accrued expenses, deferred revenue, long-term debt, and the liabilities, then stakeholders equity, owners equity, all these things are Greek and Latin. I am still trying to explore the breadth and depth of these particular words. But then in my case, since I completed my executive MBA from Great Lakes Institute of Management, and I also did my advanced strategic management program from Indian Institute of Management, IIM Kozhikode, these terms or these concepts have anyway been covered as part of our subject. So once we did a capstone project, and once we actually used to do our individual assignments and then group assignments, these terms made much more relevance to me. But then even now, when I try to hear these terms, I still take some time to really understand the contextual knowledge, not just by the individual terms. Okay, so let us now continue this particular video in terms of the current liabilities. Current liabilities are those obligations that need to be fulfilled, let's say within the next 12 months. In that, whenever I am actually trying to look into the term called accounts, payable, first I will be looking into something called a DPO. DPO stands for days payable outstanding. Longer the better, because when you are factoring the account receivable, when you are actually factoring the accounts payable under your current liability, then the days payable should be longer the better. Whereas when you are talking about accounts receivable in the asset section, you should be shorter the better, right? Okay, now if you are getting into accrued expenses, what it means is, you must accrue for invoices not received. Means what? Not received an invoice from the vendor, right? So somewhere you need to factor in this particular thing is called an accrual principle. If you try to Google ACCRUAL space principle, it is called as an accrual principle, and guys who are there in the financial domain and the financial things knows it better. I am just making this video to slightly introduce these terms to the IT guys. Okay, so if you are talking from an accrued expenses, You must accrue for invoices which is not received. Means what? Not received an invoice from the vendor, but still it will come under liability. Then let us actually get into deferred revenue. Deferred revenue or the prepayment from the customer. But then the question will come: why am I putting it in the liability, but not in the not in the asset section? Just for one simple reason: it is a prepayment from the customer for a future product or a service. So it is a amount which is received in advance, but you still need to have the obligation to be met, right? So I cannot put it under asset. I can only put it under liability, followed by the long-term debts. Long-term debts are those debts which can't be expected to pay within the next 4 months. It is a long-term debt and the EMIs need to be paid for the next 5 years or 10 years. So what am I trying to say is, before you jump to coming up with some kind of a strategies to do your business transformation, digital transformation using any of these financial things, we may need to begin the journey by understanding one by one. We may need to divide and conquer one by one. So I do have some plans to make some series of videos in the future, taking into consideration IT people generally will have some struggle to understand the cash flow statement, income statement, balance sheet driven agile transformation. So in the future video, let us try to understand one by one. So just to paraphrase this particular video before I actually end it, in this particular video I was just trying to explain you that the different components or the compartmental building blocks of a balance sheet. You do have the current asset section, which is going to contain cash and cash equivalent, followed by the accounts receivable, inventory, and if you have any other assets like a property, plant and equipment. And in your particular liability section, you had current liabilities like account payable, accrued expenses, deferred revenue. And if you can take your current liability and your non-current liability, which is going to factor your long-term debt, it is going to contain your total liabilities. Now the point is, we also need to factor something called owner's equity. And for you to get the owner's equity, you may need to take your total assets and then subtract your liabilities. What it means is, let us take a situation that the company need to be sold back. Company need to be sold. Then what is the total assets we have and what are the total obligations or the liabilities we have? If the total asset is greater than the liability, then you subtract the liability from the total asset and then pay back to the owner. So it is called owner's equity. And then in a typical balance sheet, at the end of the balance sheet, the total assets need to be equal to the liability. If not, something went wrong somewhere. Okay. So in this video, I have just covered the building blocks. In the future video, probably I will be showing you a real-time balance sheet and then explaining you, okay, if this is the balance sheet, what kind of strategies we need to do so as to create a positive ripple effect in our transformation. Because what is the point of doing a transformation if it is not having a positive impact in your financial implications? Okay, so hope to meet you in some other video. And one more thing before I wrap up the video, I do have a program called AMP, which is popularly called Agile Mentorship Program, and I have distinctive levels like level 1, level 2, level 3, and I also have a lesson plan called Agile 4Ps, which is project, program, portfolio and product management. And level 1 is for a scrum master and a team level agile coaches. Level 2 is for a enterprise agile coaches. Level 3 is for a agile leadership roles like agile COE head, delivery head, practice head, and in that particular level 3 AMP, I am also covering this particular topic of balance sheet driven agile transformation in a much more hands-on manner, because in a small YouTube video I can only touch the surface of the subject, and the purpose of this video is to introduce something called balance sheet driven agile transformation in the mind of the viewer. Okay, so if in case you actually wanted to learn more from me, I will drop my WhatsApp number in the description of this video. Feel free to ping me on a WhatsApp. Okay, cheers, bye.